Hi, I'm Jim Smith.
And I'm Martin Fox. Welcome to our second investment update for 2025. Despite some turbulence and a few uncomfortable U-turns, markets made reasonable headway during the quarter. Jim, please take us through the headlines.
Thank you, Martin. For the 3 months ending 30th of June 2025, markets initially fell heavily in April after Donald Trump's sweeping tariff plans dubbed Liberation Day, but despite the initial shock, markets gradually clawed back their losses and ended the quarter ahead as most of the original tariff plans ended up being watered down or delayed. In fact, this pattern of frequent policy reversals has earned him the nickname the taco trade, which stands for Trump always chickens out, reflecting his tendencies to back down or delay tariff plans that upset investors. The US also introduced a new term during the quarter, OBBBA, which is short for One Big Beautiful Bill Act. The Act includes numerous provisions favouring high earners and corporations. Whilst this has helped to lift stock markets, many low-income Americans stand to lose out. Despite the gains though, a degree of uncertainty still hangs over the global economy, with wars in the Middle East and Europe and a shifting geopolitical landscape. Here in New Zealand, after 2 years of being in the doldrums, the economy showed a brief rebound, but the latest growth readings remain sluggish, with sustained growth now forecast to emerge later in 2025.
If we take a quick look at interest rates and inflation, the New Zealand official cash rate was reduced by 0.25% in May to 3.25%, but was held steady at the last meeting in July, as there are signs that inflation could increase later in the year. In fact, inflation edged up in April from 2.2 to 2.5% and is expected to climb towards the upper end of the 1 to 3% target range before the year is out. The Reserve Bank still expects to lower the official cash rate further, but this will depend on inflation easing in the medium term.
Stepping back now and looking at investment returns for the year ending 30th of June 2025, the MSCI World ex-US Index, which represents global developed markets outside of the US, led the way in the past 12 months and was up 17.6% for the year in New Zealand dollar terms. Despite the steep falls in April after Liberation Day, the S&P 500 index rose 15.1% for the year to 30th of June. In New Zealand, shares and bonds also progressed nicely, gaining 8.3% and 7.4% respectively. It remained a similar picture for the 3 years to 30th of June 2025, but the S&P 500 index led the pack, rising an impressive 20.7% per annum over this period. International and Australian shares also gained strongly, but New Zealand shares and bonds moved ahead at a slower pace, gaining 5.9% and 5.2% respectively. The 10-year numbers to 30th of June 2025 continue to look strong, with the S&P 500 index rising 14.9% and New Zealand shares in second place returning 9.2% per annum over this period.
If we now look at the New Zealand dollar compared to some key foreign currencies, against the US dollar we can see the New Zealand dollar has been relatively weak since 2022 and is currently trading well below its 10-year average. Over the quarter we saw the US dollar weaken, but still around the 90th percentile. Against the British pound, after gaining ground in 2016 post-Brexit, the New Zealand dollar has been steadily losing ground and is sitting close to its 10-year low. Compared to the Australian dollar, the New Zealand dollar has been slightly weaker over the past few years, but with recent gains is now close to its 10-year average.
So with markets stable despite the best efforts of Mr. Trump and a global environment that remains fluid, what are the key takeaways for investors?
Despite the headlines, markets have delivered a year of sound returns. But with ongoing uncertainty, it is more important than ever to select a well-diversified portfolio, holding investments across many different countries, regions, and asset classes.
Whilst it may have been tempting to sell out after the falls in April, history consistently shows that staying disciplined through uncertainty leads to better outcomes, rather than reacting emotionally to short-term market movements.
Investors should also review their situation at least annually, so together with your advisor, we can make any necessary changes to your investments as your situation evolves to keep you on track to achieving your objectives.
Thank you for listening. As always, if you have any questions, please reach out to your advisor or a member of the team, and we'll be happy to help.